Hey, all right. Good morning, everybody. Looks like we're getting some Mag 7 news meta discussing using Gemini from Google to boost ad targeting. So they're reverting back to their old ways where they target you with advertising and use your phone as an addict model. And yeah, good times. Lots of talk about a government shutdown and the clock is ticking. It sounds like Wednesday they'll run out of funds. That's a loose estimate. It could be by Monday if they get a big bill over the weekend. It sounds insane that they're sitting there, with their coin purse trying to pay the bill at the register with loose change, and it's the government. Looks like the Oracle deal has been approved by the president. And Germany's buying some missiles. So, it's another day in the neighborhood. Mostly green. Japan down 0.25%. Small caps, they're our bellwether. Just slightly in the red. Nasdaq and the S&P flat. Hong Kong also flat. The Dow's trying to get somewhere. It's just not doing so good yet, but it's closer to a quarter than anything else. Europe's up by a half. So all the usual drivers that we have in the morning, we don't have them. We don't have our own indexes. We don't have the small cap index. We don't have the China ADRs this morning. And while Europe has been down a lot recently, they're the one that's up this morning. Down is up and up is down today. So we're going to get more Fed speakers today. Remember, we're getting 14 out of the 19 Fed speakers by the weekend. And they did a lot of it yesterday. Looks like they're going to finish it up today. The sentiment at 10 a.m., I'm not really interested in that. The numbers are fine. Plus, it's just a warm, fuzzy feeling number, and nobody cares. The PCE is really close together. So, unless it shocks or surprises, that shouldn't be anything either. It's just going to be headlines and gotcha news out of the White House. They're applying tariffs on everything, including the kitchen sink, um, cabinets, kitchen appliances were already on there, but now it's going to be the sink, the countertops, the cabinets. It made me wonder, and I don't know because I'm going to have to go dig into it. But do those box store places like Menards, Lowe's, Home Depot, the cabinets that they sell, are they made in America? Because if they're not, then we're likely to see those guys get hit when they have to pay 100% tariff on things or whatever the tariff happens to be. But he's back slinging tariffs around all willy nilly. So as I said, unless this number surprises, it should be fine. We're just going to be focused on headlines that come out. Maybe we get some gotchas from the Fed where they ask just a trick question and get them to say something and then splash it on the news. That's possible. I think the last time they really played that game, they got hit. So they don't seem to play it very much anymore. The CTAs we're just digesting up here, right? They're not really selling off. We're talking about this green line here. That's the CTA positioning. So that previous high held for the S&P on CTA's positioning. For the NASDAQ, it's lining up more like a Busby, right? The old concept of price in a range, testing against resistance, and then it finally breaks through that resistance and pulls back to check prior resistance as new support. Yeah, I don't like saying all of that when I can just say it's a Busby. So if it breaks through the top of this and comes back inside, then we know it wasn't a Busby. Otherwise, it is still digesting up here. It really isn't leaving and heading down like it has, if they wanted to get out, boy, they can get out, right? They're not doing this, not yet. Still got that move in crude. Looks like they're not quite sure what they want to do with gold here yet, but the pullback is minimal. If we was to snap a fib there, that's not even a 786 yet. It's close, sure, it's close, but not that yet. Still no change in the call wall or the put wall. We're underneath the volatility trigger, but we're still above the 0 gamma line, firmly inside of yesterday's range, holding above the 20 period daily moving average, and we're working with reciprocation on the VWAP. Whatever we got above it, we've got below it, and we're just sitting here. At some point, I've started calling this a zipper play, but the outcomes are a little, they're a work in progress. So when it's a really tight play like this, and with the VWAP running through the middle of it, I've started to call that a zipper. It's just an indication that we're running in this tight zone, and at some point we expect to leave the zone, right? So keep your eye on it. It's a really nice little compression, and we just expected to hold this, but we can't hold it forever, right? We're going to break the zipper and we're going to run. Question is, which way are we going to go? And that's the rub. So we don't try to guess or assume or anticipate. If you think it's going to go long, try to grab it along these lows when it's down here. And if you think it's going to go short, then try to grab it across those highs up here. That's really just the meat of it. Otherwise, you're a confirmation trader. You got to let it break down and then try to get it after the breakdown has begun, which is fine, right? If we do break down, we've got destination trading. 6632 cog line is down here. So once we break the low and begin to expand, that's your destination, and you can just use destination tactics. Same thing the other way around. If we break to the upside, if you aren't able to get in along the lows, you have to wait for confirmation by getting the breakout. Get the breakout, targets last previous day's high, which would be way too far. Target would be 6692 cog line. That's a more realistic level. But to even get that, you got to get back above the 10-day moving average, which looking at yesterday, we cut through that 10 like it wasn't even there, right? But if you look at it on Wednesday, 10 was responsible for interacting with the market. We could see the same thing today. Looks like they took a front run on it already. Still, if we can get through that, then 6692 cog, and above that 6700. If we don't get back above this 10 soon, we're going to get a 310 cross to the downside, and a 310 cross is what I call a surge signal. If it's moving to the downside, then it's a surge bear surge, and if it's moving to the upside, then it's a bull surge. This is an example of what that looks like, right? Price crosses the 3 and the 10. Because price is above the 10, it brings the 3 with it. You get a 310 cross, and you got a surge play. There are, of course, fake outs because it's just an indicator, right? Indicators only know price action. It doesn't give you any bias. So there's seesaw and whiplash. And if you were trying to use that for a trade trigger, it would suck. You wouldn't want to do that, right? Don't want to use moving averages as entries and exit criteria. More of just an analysis bias. If we cross through here and hold underneath that 10, we're going to bring the 3 under the 10, and that is a bear surge signal. But that does not mean that we're going to crash and burn, because we brought it down here, we brought it down there, we almost brought it down right there. Hand grenades and horseshoes almost doesn't count. $66.55 is one of those combo levels. If you go over to the Spot Gamma website and you read about their gamma levels and their combo levels, they'll say that they're really important levels that oftentimes come into play more frequently because they're not so far away, as opposed to the call walls and the put walls that are nearly always too far away, right? It seems like every day when we come in, we're nowhere near the call and the put wall. So those combo lines are more frequently used because we're interacting with them more often on a day-to-day basis. Pay particular attention to the levels where they are at. So we got 66.70, 66.55, and then a cog line 66.32, 21. Those are all either volatility triggers, zero gamma, or combo lines. Looking at the overnight, we're less than 70, but the average has been running in the 50s. So getting really close to 70 shows that we had more participation last night. It's not enough to upset the apple cart. We don't have to go trying to figure out what was happening or what's going on. We did get a generous move in the kill zone. You can see starting at 2 a.m. And then we unwound that already. So we're back to where we started. It was a relatively tight initial balance last night, all things considered. And if you've read that book, Secrets of a Pivot Boss, you'll understand the implications of a tight IB, initial balance. We don't have anything yet at this point, right? We're just towing the line. So you can see we're hanging out at yesterday's midpoint. If we measure everything from yesterday, that's the mid. We're crossing back and forth through that a lot like reciprocation. What we got on the bottom, we're getting on the top, yada, yada. We're just hanging out. If we measure only the RTH, 66.50 is the halfback of yesterday. It's a nice centered number. It's our options level. We always pay particular attention to those 50s. So we don't really need that measurement other than if we get a breakout. And look at what Globex did last night when it ran to the upside. It just stopped at the intraday high. So we got to get through that intraday high to do anything else. And if we can get through that, then we'll focus on what we can get above with the measured moves. 111, 1236, that gives us 66.80 and 66.87. So there's our 3-day pullback. Like we were talking the other day about reversal signals and swing lows, swing highs, morning stars, evening stars, belt hold above the stomach, all of those funner ones, right? So we want to think about this reversal off the 20. Yeah, it didn't just touch the 20 and bounce back up. That's kind of unrealistic. But, you can reverse off of moving averages even after cutting all the way through them. Getting a textbook perfect tag is not common. I mean, we'll take it when we get it, but you just got to get used to the fact that they're going to overshoot. So we overshot the 20. We did one of those little loopy doops. But when we came back up, one of the things that I like to focus on is how did we close? Where's the midpoint on that close? And did we close above the mid or below the mid? Because if we're below the mid in any way at all, it's kind of bearish, right? If it's anywhere above the mid, even just a little bit, it's kind of bullish. The closer to the bottom of the candle we are, the more bearish I would be about it. And the closer we are to the top of the candle, the more bullish I would be about it. So on this reversal yesterday, we didn't close well. We closed underneath that half. And now today, of course, we've got to get above the half. And we did that multiple times, but we wasn't able to keep it. And that doesn't bode very well either, right? That's not an encouraging signal to see that we were able to get through the half and we couldn't keep it. We couldn't get out of yesterday's RTH range. And that's what we're stalling on. Or we got the 10 period right over our head, and that's what we're stalling on. It doesn't really matter which one of those. It could be both of those. We're just stacking more stuff on top of it, saying there's this, oh, and then we got to get through this. And yeah, don't forget, we got to get through this. That's a lot of stuff overhead. But we did get that reversal. So we want to examine that reversal more closely and try to evaluate, did we run out of sellers and just sort of buoy back up again? Or did we actually drop down into a bunch of buyers and they ran it back up again? Because that would be two entirely different scenarios. At this point, we are inside day. That's pretty obvious, but it's a really wide inside day that we're inside of. So it's not going to be, one of those IX10 with tight compressions and a big breakout, not a squeeze type setup. We did get a nice drop down. And so far, that's a good working piece of information, but we're not lower than this low yet. So we don't have a lower low. We still have a higher low. We also don't know if this is going to be our low because today's candle isn't done yet. For all we know, we're going to come down and we're going to put in a lower low, and then this candle won't have mattered at all. It will only matter if we rise back up and we get more than, say, halfway through up here. So get above 66.92 cog line, and then we can look back and say, oh yeah, that was a higher low. Right now, we don't know that it's going to be a higher low or not. It's shaping up to be a higher low. This feels a lot like a TRB setup. If you're interested in what a TRB setup is, it looks a lot like that. The reason I focus on them is look at that reversal bar. I really like that reversal bar. That's what makes them so fantastic. Now, we don't always get such a fantastic reversal bar like that. But when we do, we get back to the top of the range in a single bar. So it might take 5 bars to get down there, 1 bar to get back up. That's why it's so awesome. It's a single shot all the way back up again. When it doesn't get all the way back up, but it gets close, you usually get the next day's candle that follows through and gets you to where you're headed. So, it's a really nice setup when we get it. We don't know that this is going to be the TRB setup or not. The defining characteristics that is going to start the whole thing off is that we can get above the previous day's candle. And that's a long ways off, and it's almost halfway back to the top of the TRB level. Well, that's not very cool, right? We got to wait that long just to be able to get to play? I don't think so. So we want to be looking on the intraday for any signals that says we can begin to go long and then just keep the focus on, say, the open and then the high of that day, and then the open of the previous day and the high of that day, right? Just keep aiming for higher and higher targets. And as long as it continues to move in the correct direction, just keep running it. I'm not saying you got to stay in the whole time either, right? That's kind of unrealistic. Get out, lock in gains, get back in again, right? It's the whole idea of, can you get back in? Can you get another bite of the apple? Why not? As long as it's still behaving and moving in the same direction. So we have a potential TRB. I like those because of its often very responsive single bar achievement. That's what makes them so great. If we don't get it, then fine, we don't get it, right? And it doesn't have to happen today. Like this one here, we paused and then we shot up the next day. So, you know, it could do that. Same thing here. That was a green day at some point. And it wasn't for very long, but you could see that wick there. So it turned green for just a little bit, and then it didn't stick. And it closed inside the previous day's range, and then we got the shot. This could be the same way. It could end up closing red, sitting inside the previous days, and then for an example, on Monday, we could run up and tag that for all we know, right? We have a market maker move this morning, which is a little odd because we looked at the economic schedule today and none of that appeared threatening. Am I missing something? There's no numbers that stand out as a gotcha. Everything's close together. We don't care about the sentiment stuff. Maybe it's the Fed vice chair, but I doubt it because that's 1 o'clock. It's too late in the day. I don't see anything else on here that would potentially cause them to want to hedge. But, you know, it doesn't matter that we can't see it. The whole reason for using the market maker move is to identify when they are hedging. So nothing on that screen just showed a reason for them to hedge, but they are hedging. This isn't my opinion. I'm not guessing. I'm not making any assumptions. They're doing it. And if they're going to spend that kind of money to protect, and it is cost for them, right? That's not a trade. They're not trying to profit here. They're just trying to protect. And if they are, watch the clock. This has a lifespan of the end of the day, so it will begin to shrink at some point, but keep your eye on it. When does it begin to shrink? If it's still growing, then the event is farther away. And of course, at some point, the event will pass, whatever it is, and then this will start to shrink. And if it, for no other reason than by the end of the day, it'll just dissipate and disappear. If you don't have this, as long as you've got options, you can see it for yourself, right? The Thinkorswim, the people who made Thinkorswim, Tom Sosnoff and all those guys, they made this up, right? It's not a thing. And so most platforms don't have it. On Thinkorswim, it's right here. It's the market maker move. If you're not on Thinkorswim, just look at the implied volatility averages. Most options platforms have this. Look at the options in the front, and then look at the next series out. And if the options in the front have a higher number than the next series out, you've got a market maker move. That's all it is, right? If you want to read more about that, Schwab has articles on it. You can just Google market maker move and read the article about it. They don't mention futures at all. You know, you got to kind of just understand what's going on and take it over and apply it to futures. So they're hedging. I don't see why they're hedging, but it doesn't matter. They're scared, they're worried, and they are protecting. The reason we consider it protection is think about hurricane insurance for your house. you're not putting that on there hoping to make some money. You're just putting it on there hoping to protect yourself if a hurricane smashes your home. It's not a way to get rich, right? It's not a way to pay the bills, set aside for the kids' college fund. You're just trying to protect yourself. Well, that's what they're doing. They're not trying to put on a trade just to make some money. Otherwise, the ADR lines are inside of yesterday's price action. The lower one is inside of the RTH, which makes it easier to hit just because we don't need a breakout to get there. But both of them are within the entire day of yesterday. So we could hit either side. Honestly, we can hit both sides. It can be that kind of day. Because there's a market maker move, that implies we could get an event bar this morning. So an event bar is where at 8:30 or whenever we get it, we get this really big bar. You want to measure that bar at its highest point and its lowest point, and then project off of that bar everything else. So we'll just use this bar here. If that was our event bar, say 8:30 came in, we had data, measure it, market's mid, and with these bars, these event bars, you can keep the 111 and the 123, but they're high flow event bars. So you're more than likely going to want to use 1.5 and 2.0. The 111 and 1236, most of the time, it can't handle the push from a high flow event like that. So you'll want 1.5 on each side. And then just project that into the trading day and look for us to get outside of the range. There's a gap close that goes with it and a couple other things that we can do, but we don't know where it's going to be. And so we'll just leave that for another day. Today's floor pivot is lower than yesterday's floor pivot. That's bearish. Price opened underneath it, and that is also bearish. We've already hit it. We've crossed through it multiple times. There's no magnet or reason to believe that we're going to have to go anywhere to get something done because we've already done everything that we needed to do. We are outside the channel of the weekly pivot. If we attempt to make any run to the upside, we have to get through the pivot channel on the bottom, and then the floor pivot itself for the week, and then the upper pivot channel. That lines up with yesterday's price action. All right, we got yesterday's RTH high. It's really close to the channel bottom. Then we've got 66.92 cog line or 66.87, the weekly floor pivot. So there's a lot of work here. This narrow box, all things considered, the channel that we have today is kind of narrow. A narrow channel implies that if we break out, it could stick and we could really run. But I need you to understand what we're talking about breaking out of. We're talking about breaking out of this. So if we can get out of this box, that narrow channel implies we could keep it and we could really run. But that channel won't make us break out. It won't help us get there. It's not even designed to cause price to do anything. It's just a perspective on, hey, if we was to break out today, what's the play? Is it likely to stick or is it likely to just turn around and come right back in again? That narrow channel implies that it would not turn around and come back in, that it'd likely keep going. Now, this isn't as narrow as it could be. It can get so narrow you don't even see a channel at all. All you would see is a purple line, and it's not that narrow. But it's really narrow. It's narrow enough. So look for the breakout to stick if we do get a breakout, but that's a long ways away. We're nowhere near that breakout point because we're kind of close to the midpoint right now. Because we're underneath the weekly floor pivot, we are in a bearish mode. As long as we are moving back towards it, that's fine. But if we begin to break down, we are in a bearish bias. So you can, hop on and play what you got. S1 is basically yesterday's low, and R1 is the top of the weekly channel. I know you probably can't see it in the stream, but it's buried inside of that channel line. We got nothing so far this morning. It's just a really nice tight range. But it's that old adage, right? I don't care where you go, you just can't stay here. Well, yeah, that's what we've got this morning. GTFO, it cannot stay here. It's way too tight. It's a 20-point range, and this isn't pre-COVID price action. So we will not hold a 20-point range all day today. Technically, we can because price can do whatever it wants. But I'm telling you, we will not hold a 20-point range. Will not. We're building out a really nice distribution down here. If we get a break to the upside, getting through 6,700 looks like it'd be easier than getting through the cog line at 6,711. We have another distribution there, and then we've got the point of control way up here at the top. If we stay here into the open, that's likely going to be enough time to bring this point of control down. If not, as long as we are in this zone, that's what I would be looking for, a shift to bring this point of control down. Looking at how that low was defended yesterday, at least on this time frame, I don't see that buyers stepped in. I just see that sellers got exhausted. Kind of like back here, right? Same thing. So we got 3 different distributions for this week, and we're sitting right square in the middle of the lowest one. So we'd have to get out of that. Where it gets shallow, price tends to move through those areas quicker. So if we did get a breakout above, say, 66.70, we should be able to get up into 66.92 cog line relatively easy, all things considered. 10-day, 30-minute volume profile in TPO. That really stands out, right? It's just, man, put that one in a pinup poster. The TPO distinguished that area much better than the volume profile did. Still, we made it back down to the lows that we had talked about earlier this week. That puts the idea that the profile's point of control very likely stays where it is. None of these others are likely going to match it. And if we do move, it's very likely going to be for a small period of time, say a day or two, and then it just drops right back down again. For every new candle we get on the right, we're taking one away from the left. As we get into Monday, we'll start wiping out these candles that made the current point of control, at which time we could see this move and bring up into 67.7 or 67.50 if we don't put in a lot of work here, stacking up a new footprint as the old one is getting taken away on Monday and Tuesday. No new VPOC from yesterday. Price has been running through it all day. And the one that we was carrying from the 17th is done. So we can take that one off the table. We don't need it anymore. We still got one overhead, but I think the date is wrong on that one. That's the 23rd. There we go. You can see how this morning we don't got a lot of sellers up here across the highs. We just ran out of buyers and faded back down. And then look at yesterday's reversals. Here we had a little bit, but down here we really didn't have much. I guess it's better than this though. Notice they're all the same size. That's why I zoomed in on it, because it was really uniform. Might have to change the statement. They did come in. They came in better here than they did right there. That's for sure. So buyers stepped in, defended that. But I tell you, that looked more like stops than active participation, right? It was too uniform across the board. Like we got into something, a firm's limit. It's hard to say, but it's certainly different than that first shallow area. It would have been interesting to see what it looked like on the dome, right? When we got down there, if those orders were present or if they were just hitting them. All right, we got a preview of next week's range this week. The problem is it's not set in stone yet. So we can measure it, evaluate it, compare it to the current week that we have. But you just got to be mindful that through the day today, it's going to continue to move, and that by Monday, it could be something entirely different. So at the moment, it's bigger than the week range that we have right now, which, by the way, we did hit yesterday, the weekly expected move edge, and now we're back inside and we're holding above it for the moment. Next week's range is projected to be a little bigger than our current week's range. So what we're not expecting next week is the 111 and the 1236 of yesterday. It's one of my favorite trades. Yesterday's 111. We're not expecting those to be very good. This implies that breakouts stick and that we probably expand a lot next week, like we expanded this week. We broke out of the previous day's range and ran, say, yesterday, for an example. We did it too on Wednesday, but we came back, right? Now, Monday, we had a nice breakout and nice expansion. Tuesday, we didn't get anywhere. We just unwound all of it. And then Wednesday and Thursday, we had expansions. Why? Because it was a bigger range week. Those tighter range weeks give us an indication that the 111, the yesterday's 111, they're going to work better because the market is expecting to go sideways while it waits on something. FOMC, CPI, NVIDIA's earnings, something that has the market nervous, and they're planning on sitting on their hands for half a week. This wide range of our current week and the even wider range of next week suggests that they're not looking to sit on their hands waiting on data. They're looking for volatility to come in and move this market, and they expect to see us actually move. We still have to look at it on Monday to see if what we have now is actually what we're going to get for next week, but that gives us an early projection. You can also circle back and look at it closer to the end of today if you want to put trades on for next week while we're still in this week's options class. So that's cool. I wouldn't play iron condors, right? Because that's saying expansion. I'd play like long verticals, or short verticals to buy long options. Sell a spread to buy a call, or sell a spread to buy a put, something like that. We're still more than 2.5% above the 10-week. That keeps us in a bullish bias that it's still a strong market, that we're not even at the 10-week, let alone underneath the 10-week, and that all's well that ends well for now. If that happens to radically change, then we'd have to change our perspective, but we're still above the 10-week, and that means everything's still fine. Now we are below the 10-day again for a second day, but we're just barely below. And we're within this margin of range that I like to work with, this 0.5% higher or 0.5% lower. Beyond that, you still got your 1% higher and your 1% lower, but that starts to get into the edges. If we get more than 1% below the 10-day, that's an entirely different discussion. Or if we get above the 10-day by more than 1%, that's a different discussion. If I put my mouse here and we just look at how often we've been below the 10 by more than 1%, it happens frequently, right? Even in good solid markets where we're headed to the upside, you just get those pullbacks with some depth to it that lasts a couple days and you get below the 10. We're not looking to do that. We're not looking to get that deep below the 10-day. And I think at this point, if we was, then we'd start to get that 5 to 7% S&P pullback that everybody's looking for. So China's down and uranium is down. Bitcoin's down a little bit, but not very much. We want to see that it doesn't get worse. Looking at what's up, the VIX is up 4.5% over a 5-day period, 0.5% this morning. The Mag 7 down volume is up. Yeah, that's a headbanger. And none of the rest of this stuff is up enough. Moving in the right direction, mags, gold miners, financials, gold itself, chips, but they're not up enough to count. So we need them to keep moving in the right direction. Otherwise, looking around this morning at, hey, what could break us out and get us to run to the upside? This won't do it. This isn't enough. This can't get it done. We're going to need something to come in. 0-day flows, bonds, treasuries, commodities, Mag 7, something. And we got nothing. We could get that dollar to move back down some. That would help. And to get the 10-year to kind of back off a little bit. But we don't want big radical moves either, right? Just kind of just nice and easy, no sudden moves. Get this stuff to back off a little bit. You do not want a rally day on pot stocks and agriculture. And yeah, sure, China's down, but China's not the big influence to our markets like the Mag 7 would be, right? The Mag 7 would bully our markets way more than K-Web or emerging markets would do it. Base case argument at this point, other than the fact that there's a market maker move, sitting there, which kind of leaves us wondering why the heck is there a market maker move, is that we just go sideways into the close and we hold this range. That's the base case argument. And it's a really big range, so that's not hard to call at this point. All we got to do is just stay inside of yesterday's candle. If we don't, then whatever direction we go, it's likely to be one heck of an expansion. To the upside, I'd be looking for TRB. And to the downside, I would just measure all of yesterday and then project that 50% and 100%. I wouldn't even mess with the 1, 2, 3, 6. It doesn't mean I'm going to take them off, though. I'll leave them on there and see if we do get a reversal off of them with one of the candles that might matter, right? Get a morning star reversal or maybe a 3-bar swing low, a non-complex standard swing low, you know, all that good stuff. Yeah, simple enough. All right, guys, that's what I got for you. Be careful, be safe. Watch the clock. They're doing something and they're worried about it. It's very likely going to end up on a half hour or a new hour. I'll see y'all Monday.